Jerome Powell has finally made the right call. After 14 plus months of gruesome interest rate hikes, a 2022 bear market, and a crypto meltdown, the government has finally decided to pause rate hikes for the month of June. This rate pause comes in the context of CPI having come in way below most analyst expectations at 4% year over year. This number is down from around 4.9% we experienced last month, which means inflation has fallen almost 1 basis point in the matter of 30 days. And given where we've come from at 9% in June of last year, that is a pretty big deal. Because whether it be stocks, real estate, or crypto, the US economy has taken a pretty big hit. Look at oil prices, for example. They're down almost 40% since the highs we saw last year. And as we all know, oil is the simple backbone of the North American economy. And it seems like the US government is finally seeing that light at the end of the tunnel, which is a potential recession in the midst of a tight labor market, layoffs, and decently high services inflation. So, what exactly does this mean for the future of the stock market over the next couple of months? And what made the Fed suddenly decide to pause rate hikes? Those questions are exactly what we're going to address in this video. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. Following a tense 2-day meeting in Washington, D.C., the Federal Reserve has decided to keep the Fed's key borrowing rate at target range 5 to 5.25%. However, as much of a surprise as this seems, markets had anticipated this coming from a mile away. Most banks and investment bankers on Wall Street expected the Fed to skip this meeting, as officials generally prefer the term to a pause that infers a longer-range plan to keep the rate hikes where they were. Just yesterday, we learned that headline inflation of CPI fell to 4%, and this morning we learned that PPI, which is an indicator of final demand inflation, also fell to its lowest level since December of 2020. And as you can see, there is quite a clear correlation between the performances of both of these indices, with PPI leading CPI. What this means is that we are on track to achieve the Fed's goal throughout this entire interest rate hiking cycle, which is to bring down the PCE index to 2%. We all know that PCE, or personal consumption expenditure, does tend to follow what CPI does. However, right now it is sticking quite high because of services inflation, which you can see right here in blue. Although energy, food, and goods have come down significantly, services, although still trying to tick down a little bit, has been the most sticky of all. And as you can probably tell, services is driven mostly by the labor market and people's pricing power. And although this is significant progress from where we were this time last year, this is probably the biggest reason why today Jerome Powell signaled that by the end of 2023, the Fed funds rate could be at 5.6%. And that means 2 more 25 basis point rate hikes, bringing us to levels we have not seen since 2001. Yes, that would mean we would exceed the 2007 peak we saw of 5.45% in the Fed funds rate, meaning we would be exceeding tightening levels not seen since the financial crisis. Whether or not that's a good thing or a bad thing, I'll let you decide that for yourself. But just keep in mind that back then the situation was quite different from where we are today, where back then we were facing a liquidity crisis and insolvency for a lot of the banks. That led to the massive mortgage crisis and obviously the collapse of the intertwined US economy. Meanwhile, today we are facing the exact opposite in higher inflation and higher market liquidity. And although yes, it makes very little sense for the Fed to continue tightening at the end of this year with something like M2 supply hitting rock bottom, I might just know the reason why they're doing this. You see, although the Fed's job is being done quite well, with leading indicators like PPI and processed goods falling to levels we haven't seen since the pandemic, the Fed still wants markets to know that they're on the right track and that they're not going to let inflation loose once more. And that likely has everything to do with this single chart, which shows us the excess liquidity available in markets today. As you can see, this indicator is starting to tick up for the first time since the pandemic, which means markets have more upside, potentially creating additional inflationary pressures. And as you can see, every single time this indicator has hit this level of -1 to -1.5, we have often seen a continuous rally towards 0.5 and 1.0, which typically coincides with good returns in the S&P 500. And because excess liquidity has historically always risen through recessions, the Fed wants to play it extra safe by saying that they're going to raise rates more, even though they could have just done it this month and let the markets do their thing for the rest of the year. And talking of recession, let's not forget that in today's summary of economic projections, the Fed, for the first time, showed us when it expects this recession to occur. And as you can see, the answer seems to be 2024. Because from an unemployment rate of 4.1% at the end of this year, the Fed expects it to be at 4.5% at the end of next year. And historically, whenever we have seen a 4% basis, and historically, whenever we have seen a 0.4% increase in the unemployment rate, it has always been associated with recession. And that right there, folks, is the simple reason why Jerome Powell is acting hawkish, even though the data in front of us is signaling dovish. Even as economists expect an inflation slump to 3.2 by June, a historic decline in CPI, the government wants to seem right ahead of the 2024 election. Even though commodity and goods prices have come down significantly, most on Main Street are still complaining about inflation and high wages. And because the government is basically a political Ponzi scheme, Jerome Powell simply wants to seem right and not pull the gun earlier than he needs to. Whether this results in a more severe recession than we needed to have in 2024 and a potential decline in the stock market, time will tell. But as usual, folks, thank you very much for watching. Let me know your thoughts on this situation down in the comment section below, and I'll catch you guys in the next one. Take care.